Well, when the Fed, as Laurie just said, raised rates a quarter of a point last week, the vote was 9 in favor, but there was a single dovish dissenter. And guess what? We have him. It was Minneapolis Fed President Neel Kashkari. He joins us now to tell us why he voted no. Mr. Kashkari, why?
Well, thanks for having me. I voted no only because we're coming up short on both elements of our dual mandate. Inflation continues. Core PCE, the inflation number that we most closely watch, continues to come up short at around 1.7%. At the same time, the job market is very strong, but the unemployment rate's not dropping. That's because the labor force participation rate continues to climb. That suggests that the labor market continues to have slack. So if we're undershooting inflation and we're not yet at maximum employment, I don't see what the rush is to hurry up and raise rates.
So when you made that argument to the 9 others, why did they disagree?
Well, I think it's just degrees. I think some people are worried that if we get behind the curve that we might have to raise rates more aggressively. But for the past 5 or 6 years, the Federal Reserve has consistently overestimated inflation. We keep thinking inflation is right around the corner, and then we're surprised when it's not. I'm saying let's be patient. Let's let inflation, it's still undershooting our target. Let's let it move closer, and then we can raise rates when the data supports it.
So the general consensus, though, Mr. Kashkari, is that the Fed will raise rates maybe at least 2 times more this year. Would you agree?
I think we should wait and see. Let's let the data tell us. Again, I don't think it's useful to make these kinds of predictions. People get very upset when we're wrong, and we've been wrong a lot the past few years. My reaction is let's just wait. Let's let the data move towards us. When the data moves, we have plenty of time to raise rates.
So what should the Fed be doing in your mind?
Well, I put out a piece on Friday explaining the data that I look at, and one of the things I said is I want us to get going on the balance sheet. As you know, we expanded the balance sheet with quantitative easing. What I'd like us to do next is to put out a detailed plan to the markets on exactly how and when we're going to normalize the balance sheet. Let the markets absorb that information, and then as the balance sheet starts to roll off, we can return to using the federal funds rate to remove accommodation as the data supports it.
So you say also be wary of what the markets are telling you. Explain that.
Well, you know, the markets have been projecting a much lower federal funds rate path than policymakers have been predicting. So the markets have been expecting less inflation in some sense than policymakers. So I look at a range of data. I look at the actual data on inflation, both core and headline. I look at inflation expectations. I look at wages. Even wages have started to climb up slowly, but they're not yet at levels that we should have any concerns about. And so all of this data tells me there's no rush. Let's take our time and get it right.
So you don't see us reaching that 2% level on inflation by the end of the year, maybe not until next year?
Well, on a core basis. So we know that energy prices are volatile. Energy prices have gone up. They're ticking back down again. I would expect on a headline rate, including energy prices, to tick back up. But on a core basis, no, I don't think that we're going to hit 2% this year. I hope we hit it next year.
All right. Neel Kashkari, thank you so much for joining us. Appreciate it. Interesting point of view, and be interesting to see if you can influence any other members of the FOMC. We appreciate it.
Thank you very much.